Good day and welcome to the Q4 and FY24 earnings conference call of NGL Fine Chem Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Mehra from TIL Advisors. Thank you, and over to you, sir.
Good afternoon, everyone, and thank you for joining this Q4 and FY24 earnings conference call of NGL Fine Chem Limited. The results and investor updates have been uploaded on the stock exchanges. To take us through the results of this quarter and answer your questions, we have with us today Mr. Rahul Nachne, Managing Director, and Mr. Rajesh Awande, Whole-time Director and Chief Financial Officer. We'll be starting the call with a brief overview of the financial performance, which will then be followed by the Q&A session. I want to remind you all that everything said in this call reflecting any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with the uncertainties and risks that the company faces. These uncertainties and risks are included but not limited to what we have mentioned in our annual reports, which you'll find on our company website. With that said, I'll now hand over the call to Mr. Rahul. Over to you, sir.
Thank you, Abhishek. Good morning to all of you who have joined us on this call. It is with great pleasure that I welcome all of you to the Q4 and full year FY24 earnings call of NGL Fine Chem. As we can reflect on the last year, it is evident that our company has demonstrated remarkable resilience and growth despite the challenges and market conditions that prevail. Let me start by highlighting the few financial metrics for FY24. Revenue from operations grew by a robust 21.8% year-on-year to 338.69 crores, driven by strong volume growth across our product portfolio. EBITDA witnessed a significant increase of 55.22% to 53.27 crores compared to 34.32 crores in FY23. EBITDA margins expanded by 329 basis points to 15.7%, reflecting our ability to optimize operational efficiencies and leverage economies of scale. Profit after tax stood at 41.32 crores, nearly doubling from the previous year's figure of 20.50 crores. Throughout FY24, we faced significant headwinds. Subdued demand, high customer inventory levels, and currency volatility in key markets such as Egypt, Pakistan, and Turkey. These factors initially constrained our performance and created a highly competitive landscape marked by intense pricing pressures. These challenges initially constrained our performance and created a highly competitive landscape marked by intense pricing pressures. However, as the year progressed, we observe a gradual easing of these challenges. The inventory destocking phase, which had a significant headwind, finally came to an end, leading to a notable recovery in demand, particularly from the Asia region. This recovery was driven by robust volume growth, even as average realizations remained stable. Additionally, a significant reduction in raw material costs allowed us to return to normalized margin levels, contributing to an overall improvement in our financial performance. Our strategic focus on maintaining a diversified product portfolio and not relying excessively on any single product, customer, or geography has been the cornerstone of our resilience. This approach has enabled us to navigate the volatile market conditions effectively and sustain our growth momentum. Looking ahead, we are cautiously optimistic about the future. The demand recovery we have witnessed is encouraging, and if it continues to remain robust, we may explore the possibility of outsourcing some manufacturing to capitalize on growth opportunities till our new facility becomes operational. Our CAPEX plan is progressing well and remains on track, with the first phase expected to be completed by the end of Q2 FY25. We anticipate sustained demand for the coming year, although margins may take time to fully recover. we expect EBITDA margins to remain within the 14 to 17% band for the next financial year. Our focus will be on gaining market share and growing our business while maintaining financial prudence and sustainability. Before we proceed further, I must issue an important disclaimer. We have observed that competitors might use the detailed information from our public disclosures to their advantage. Therefore, we will be exercising greater discretion in the details we share going forward. We request your understanding and cooperation in refraining from asking product-specific questions during this call, as such queries will not be answered. This step is crucial to safeguard our strategic interest and maintain our competitive advantage in the marketplace. Having said that, I now open the floor to any questions you may have, keeping in mind the disclaimer I have shared. We will endeavor to address your queries to the best of our abilities while maintaining the necessary confidentiality. Thank you for your continued support and trust as we navigate these times with cautious optimism and a focus on sustained growth and value creation. The floor is open now for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. So congratulations on a good set of numbers, and that too in a challenging environment. So a couple of questions. First, on the gross margin side, sir. So this current year, we have ended with a gross margins of around 53.2% for the full year, financial year 24, and was somewhere around 52.5% for the fourth quarter. So as far as the gross margins, you have given a guidance on EBITDA margin. So as far as the gross margin is concerned, given the product prices and the raw material prices, how do you look at the next 12 to 18 months?
Is this the only question or you have got something?
No. Okay. So the second question is on the other expense side. The other expenses, sir, has seen a sharp up move in last 4 quarters, more so in the last 2 quarters. General average was around 16 to 18 crores on a quarterly basis, and this is for last 2 quarters jumped to almost 21 and 25 crores. For the full year, we are at 81 compared to 67. So is there some kind of one-off, or is there some kind of expense, the fruit of which could be in the future, maybe something on the new plant, or if you could share some details on the sharp increase in the other expenses. And last question, you mentioned in your initial remarks and your presentation commentary with regards to outsourcing, the possibility of that. So do we envisage a possibility of outsourcing in this current year itself? Those are my 3 questions, sir.
Right. So your first question was on the gross margins, and what you think, you asked me what you think would be the situation in going forward. So currently we are more or less in the range of about 47%, 46, 47%. That's material cost, so gross margin is probably the reverse of that, about 53%.
Yes.
As compared to 50% last year.
Oh.
So it's improved in the current year. And going forward, we expect that, this sort of margin will be maintained.
Mm-hmm. Okay.
With regard to other expenses, your question was, we have gone from 67 to 81 crores. So there has been an increase in the total operating cost. And this main increase is mainly on account of fuel, power and fuel basically, which has contributed a large amount to the increase. So out of the, let's say about 15 crore increase, About 4.5 crores is just cost of power and fuel. About 2 crores is cost of processing charges, but that's mainly to our subsidiary. So in the consolidated, after consolidation, we still have about 5.5 crores outsourcing. So we have been gradually increasing the amount of outsourcing which we have been doing to meet the incremental demand which is emerging from the market. So going forward, higher cost will prevail, no question about that. And with regard to outsourcing, as I said, we have been gradually doing it since last year. Our total cost as compared to the earlier financial year has gone up from about 3.5 crores to about 5.6 crores. So that's been a significant jump. And going forward during the current year also it will go up. So as and when we feel that there is going to be a supply issue, we address it by outsourcing our production so that this market is not lost. I hope this answers your question.
Yeah. So just one bit over there. Our growth in top line, and you mentioned this in your commentary also, in last 2-3 years it has come majorly from the Asia Pacific region and the India region. Europe continues to stagnate at around 80 crores business for the full year. In fact, last year it has come down to 72. So yes, on one side Asia Pacific and India has helped us and the rest of the world. Anything on Europe in terms of demand recovery or some kind of scope for there?
So as I said earlier also, our sales to Europe has been basically, we don't have any significant product registrations in Europe as of now. So all our customers in Europe who are buying it for re-export. Now, as the domestic presence grows internationally, buying in Europe and exporting to these countries is gradually going to reduce. So we are getting our roots directly now into the end market, which is a good thing for us. So the rest of the world, as it is theoretically called, regulated and the rest of the world, market is growing at a much faster pace than the EU and American ones. And I think Europe focus will probably emerge a couple of years down the line as we start getting some product registrations done. But right now the focus is very much on the ROW market, and that's doing well for us.
Sure, sir. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Dhwanil Desai from Total Capital. Please go ahead.
Hi, good afternoon, sir. Congratulations for a very strong performance in a very challenging year. So my first question is, I think you mentioned that the large part of growth is driven by volume this year. So, if you can give some range and, we also talked in last call also about realizations and prices bottoming out. So how do you see the trend on the realization side moving into FY25? And how do you look at the volume growth in FY25? That's my first question.
Yeah,
you want to put all the questions together?
Or you want to go one by one?
Yeah. So, sir, second question is on the margin. I think, again, we have always maintained that our steady state margin range is 17 to 22%. And, this time we are saying that this year probably will settle in 14 to 17% range. And idea is to gain market share. So, is it that, this is a conscious strategy that we want to be more competitive, or is it the function of the competitive intensity which has gone up, which is leading to the lower gross margin and maybe hence the lower EBITDA margin, or the third one that we are kind of investing more for the next 2-3 years and hence the margin range would be on the lower side? So that's my second question. And third question, sir, is on the upcoming plant which we are kind of putting up for largely regulated markets. So if you can talk a bit about, in terms of the groundwork that we are doing to ensure that, in FY26 and Q4 when the plant comes up, how do we fill that capacity? So in terms of the new products, registration, tie-up with the customer, and whether the nature of the business in those markets will be significantly different than what we are doing in the other markets, say in terms of the contractual things, in terms of the stability of the margins, etc. So more color on that if you can give. So these are the three questions I have.
Right. With regard to your first question on the pricing and the volume growth, as I said earlier in my earlier call also that in 2023 we have seen a steep decrease in prices, which started around the time when China opened up in February of 2023, and by August we saw prices slide down about almost 30-40% from the peak. And they continue to tumble, though at a slower pace, till about probably around January or February this year. So what we think is that the bell curve is more or less bottomed out. It is now flat currently. We haven't seen the price rise occurring yet, except for in a couple of isolated products. As a gradual rule, the price increase has still not taken place, but we see that the bottom of the bell curve is achieved. Now, at these low price levels, the demand is going up quite a bit because buyers have never had it so good at such low prices. So, demand is definitely increasing. That is driving the volume growth. With regard to the margins, because the prices have been more or less at a long-term low, we think that the current year margins will continue to be depressed. If we try to increase our margins at this juncture, we are likely to lose out on market share, which we don't want to do. So, we will continue to operate at lower prices, price realizations, and margins will continue to be suppressed. And it's a conscious strategy. It's a conscious decision which we have taken. With regard to our upcoming plant, currently to prepare for, we can't prepare for the US market because US market registers the plant. So that will be done as and when we go into production. We'll have to first do validation batches. So the US stream is still probably another 3 years away. But we have started registering our products in the European market, and filings have already started. And these filings are transferable from one plant to the other. So that work is already started by us. So as and when the plant comes up, we'll at least have preparedness to start selling into Europe.
So can you talk a bit about the nature of the business? Is it very different than what we do in the regulated market in terms of contracts, in terms of timeline, in terms of margins?
It's very different because of the effort which goes into registering a particular product. You have to work closely with your customer. And once the customer has you on the file, he normally does not work with more than 2 or 3 suppliers at any given point of time for any single product. So the relationship becomes much more stronger and longer term. Whereas in the ROW market, it's completely price driven. So yes, it does become a longer term relationship.
Okay. And sir, one just follow up on this margin. So essentially, we are baking in a stable price at current level. If the prices realizations go up, then there may be an upside to the margin, which as of now you don't see prices going up. That's a fair reading, right?
Yes.
Okay, got it. Thank you. That's it from my side.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers. Sir, my first question was on, with the current capacity, with limited outsourcing, we have reached almost 100 crore kind of quarterly run rate. So, given our outsourcing might increase and, in the past we have done debottlenecking also. So, at the existing plant, what kind of revenues can we generate, if we increase capacity, if we increase outsourcing and maybe due to some debottlenecking that we have done in the past? So that is the first question. Yeah. Second question was on, European filings we have been doing for almost a year, almost more than 2 years, more than a year or almost 2 years, I think, if I remember correctly. So any success in getting approval for single or more than a single products? How many products filing have we done till now? And how do you see, like when do you expect the approvals for the same? Thirdly, on our product basket, how many products do we have currently? And we had set up a target of into commercializing 5 products every year. So where are we on that path? And how are the new products that we had launched in FY23 and FY24 doing?
All right. Okay. Thank you for your question. As you said, we are already at high capacity utilizations, and where do we see going forward? So capacity utilization is definitely high, no question about it. We have been able to still drive volume growth because we have been continuously debottlenecking operations, and at the same time, as we are scaling up, we are outsourcing our production. And this will continue continue to do going forward. Now, with regard to how much revenue this can generate, unfortunately, I am not able to give you any revenue guidance. But our endeavor is always to ensure that whenever we see that there is a volume growth, we try to increase the outsourcing and ensure that we are not slipping out on any of the demand which is there in the market. With regard to EU registration, we started our filings exactly 2 years ago. May 2022 was our first filing. And normally it takes it used to take something like 15 to 18 months to get product approved in the EU. But now there are 2 issues which have taken place. Due to COVID, there has been a backlog which has been built up. And they are also asking for numerous other additional studies to be conducted, like genotoxicity and other studies to be conducted, which is taking time. So, unfortunately, I am not able to give you a time frame. Our estimate initially was that it will take us between 18 to 20 months to get registrations done. It's already 24, and we are still in the process of replying to the European authorities. So our fingers are crossed. I would not like to give an opinion about when this will come through because that's no longer in our hands. Your third question was about new product launches, 5 products which we aim for every year. And we have not done 5 new products in the current year. In the last year, we have done only 3 new product launches, but they have worked well. We are now doing a basket of close to about 30 odd APIs, and we are in the process of getting these done pretty well. And our market share from our top products, 10 products, gradually has been decreasing over the last 3 years, which shows that sales is now coming from a wider basket. So that's the whole objective of trying to de-risk it.
Sir, can you tell us like how many products have you filed in Europe till date?
How many products?
Have you filed in the European markets for approval with the European regulators?
Totally 8 products have been filed for.
Okay, so this has ramped up significantly. Of course, the approval is given, but we continue with our filings in the European markets.
I'm sorry, I missed your second question.
So my point was that we have continued filing.
But the line for you sounds muffled and it's low in volume. I request you to please use the handset while you're speaking.
Yeah, sure. I'm using handset only, so I'll just repeat a bit loudly. So we have continued increasing our filings in the European market from one product that we had filed 2 years back. We have filed 7 more products in the past 2 years now.
Yes, that's what I said. We have a total of 8 filings as of now.
So, sir, my last question was on the margins front. Like prior to FY22, our gross margins have remained in the range of around 55 to 60% for a very long time. Let's say almost 7-8 years we have been able to maintain that. Last 2-3 years have been challenging, given the inventory destocking and the pricing pressure. Do you think over, if not next year, but let's say from FY26 onwards, our base business itself, excluding the regulated market business that we plan to do, will come back to its original gross margin levels of around 55 to 60%?
I am very hopeful, but I cannot comment on that, unfortunately, because there are macroeconomic factors at play over here right now, and whatever margins might have been earned, there have been ups and downs, and I've always said that EBITDA margin, what we strive to do attain is between 17 and 22%. And that's what we would try to attain in the long term. I don't want to comment on the gross margin because that can go up and down. But yes, last 2 years have been challenging. Margins are depressed. 2 years after COVID were fantastic. It was much more. So in the long run, yeah, we'll get to that particular margin level.
Thank you, Mr. Walsh. All the best. Thanks.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Ishan Thakkar from 4th Capital. Please go ahead. Ishan Thakkar, the line for you has been unmuted. You may proceed with your question. As we are not getting a response from the line of Ishan, we will proceed to the next question, which will be from the line of Shivan Sarvaiya from Hamification Investment Advisors LLP. Please go ahead.
Hello, am I audible?
Yes, you are.
Good afternoon, sir. So a couple of questions. One was on the margin. So like the previous participants also mentioned, we've always been in the range of 17 to 22%. And now we're looking for 14 to 17% for FY25. So, sir, is it because of some intensity in competition that has increased in our top 3, top 4 products, or is this just a small cyclical downturn, and we plan to get back to those margins moving ahead?
Ishan, actually, this question was already answered a little while ago. This was the first question which was asked with regard to the margins. Margins, you're right in saying that, long-term margins have been in the range of 70 to 20%, 22%. Currently, they are lower. They're in the range of about 14.5%, 15%. And we gradually hope that they will, go into the range of about 17%. And this is because of various factors. Low demand led to so COVID basically led everyone to believe that there's going to be a very large sustained demand. A lot of capacity has been added into the industry, especially in China. Chinese were out of the market for a long time and came back after all controls were relaxed in February last year, and they started dumping. So it's competition is very intense right now, and again I'm repeating myself in saying that we think that the bell curve in terms of pricing is more or less bottomed out. It will only go up, but we don't know when it will start going up. Prices are depressed right now, so margins will continue to be depressed. As and when prices start recovering, we hope that margins will also recover.
Okay. So you mentioned about the additional capacities that came up in China, sir. Are these yet there? Do you expect them to move out of the market?
I am unable to comment on anything from China because we don't have any first-hand report which comes in. We just have news which comes from the market. So I would not like to comment on second-hand reports and tell you whether this is sustainable or not. Really don't know about an answer to that.
Sure, sir. So my last question is on the new plant. So since we are targeting regulated markets, so what would be the asset turn that we would be looking at on a 140-150 crore investment?
Probably about 2x.
Okay, sir. Okay. Thank you. That's it from my end.
Thank you.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. One thing on the employee costs, we have seen that, apart from other expenses which you highlighted have increased because of, fuel and power expenses. Our, employee costs also have seen, significant jump in the last year and even in this quarter. So, is it the team building which is happening for the new plant or, if you can talk about the increase in the employee costs that we have done in last year?
So we have seen it go up from roughly about 34 crores to I think about 41 crores. Let me just cross-check my numbers. About from 37 crores to about 45 crores it's gone up. So that's about 8 crore increase, which is about 20%. Part of it is because, salaries go up by 10%, 15%, 12% every year any which ways. And part of it is because of, as production requirements went in, we had to hire more people. And whether it's on account of the project expenses cannot be charged to P&L. They have to be capitalized. So nothing on the project is getting reflected on the P&L yet.
Maybe on the sales team, we might have increased some people since we are feeding the.
No, it's all around. It's not just sales. It's sales and overall. Our volume growth has been substantial, and to meet the increased volume growth, that means more material to be handled, more buying to be done. So the requirement of personnel has been across all departments.
Okay. So what kind of volume increases have we seen in FY24?
I am unable to give you, product-wise.
And the other range, if you can give on a company level.
I can give you just a guesstimate, and I don't want to give guesses right now. So I don't have the data available with me right now.
Okay. And the price erosion that you had spoken about, in FY24 also, as you were saying, some gradual decline has happened till January, February. So, compared to FY23, what kind of price erosions have we seen in, let's say, some of our molecules? In FY24?
We have seen prices go down from a range of about 20% to 40% from product to product.
Last year itself, FY24 itself?
In FY24, yes.
Okay, so this is the addition of the kind of decline we saw in FY23. So FY23, we saw big decline, and last year also was a big decline in terms of...
No. The decrease has taken place in FY24. It started in February 23. So in FY23, it just started. The main decrease took place in last year.
Okay. So if you factor that in, despite that we have seen at least 18-20% kind of revenue growth. So logically that gives us a number that the volume growth would have been significantly higher in FY24.
Correct. Yeah.
Okay. Thank you, and wish you all the best.
Thank you. Participants who wish to ask questions may please press star and 1 on their touchtone telephones. Ladies and gentlemen, to ask a question, you may press star and 1. We have the next question from the line of Debashish Neogi from Digitian Investment Inc. Please go ahead.
Congratulations, sir, for a good set of numbers. Not only this quarter, sequentially, we have been doing very well. And whatever you have been guiding, you have been very cautious in giving guidance and conservative in giving guidance, and we have been meeting that. My question to you, sir, is that always you have maintained that we operate in an unregulated market where our competitive intensity is very high. We don't have pricing power, and hence the most of the top line growth came from volume. Now, you said, and we have read in annual reports that we have filed for products in Europe, 8 products. Now, my question to you is that this is a strategic shift of operating from a non-regulated market to a regulated market. So, in that case, our competitive intensity will be lower than before. And what would be the opportunity size? Because all the years we have been, looking at very small size of the pie in terms of when we launch a product. So, my question to you is that this 8 products going forward, if you fast forward 3 years from now and assuming all the 8 products have got approval, what would be the opportunity size which we'll be fighting for?
Sorry, I missed your last sentence.
So what I'm saying, sir, we have filed, 3 products, in 22, 23, and in total we have filed 8 products for Europe, right? So I'm saying, what would be the opportunity size, in these 8 products you feel after 3 years? Hello?
Yeah, I got it. Actually, I would not like to give a guidance on this because everyone is aware of what are the products which we have already filed, because that information goes into public knowledge. So I would not like to share data about sales potential of products, because this data can also be used by competitors. So please excuse me, but that data becomes of a little confidential nature.
No, I fully agree. I appreciate that. So I will ask, let me ask you in a different way, which may be helpful for you. So today, say a long-term average, if we look at, say, 5 years, 10 years, our top-line growth has been in the range of 15%, 17% CAGR. And this, I would assume, sir, because we don't have pricing power, a majority of this is coming from volume. So if we fast forward for the next 5 years, I'm not looking for guidance. I'm saying if our historic growth has been 15, 17 years for the last 10 years, can we assume that our top-line growth for the next 5 years, CAGR, should be above 15%, and there will be a price growth into it because of Europe getting into a regulated market?
Well, that is our objective. We want to keep on maintaining a growth level of that level.
Right. And in that process, you expect the operating margin which you had been guiding now of 14-17% will be a notch higher than what it is today?
So we come back to it. Yeah. See, again, I would love to be more specific, but I don't have a looking glass in the future. But I hope, looking back on on the past and looking at the history, that we should be able to get back to a margin range of 17% plus. And last year, during our worst quarter, we were probably at about 10%. It's gradually climbed up to about 15%, close to over 15% in the last quarter. And we are looking forward that it will go up in the coming year.
You have been a great allocator of capital, okay, and which is why you are earlier you thought you would be spending the entire 140 crores, and now you're doing it modular. You spend 45, now you'll be spending another 25. So my question to you just answered the previous participant that your asset turn will be 2. Historically, it has been more than 2. So even if it is 2, this you expect to happen in the next 1 year, 2 years, 3 years? When you are telling about the asset turn, you're looking at the turn after 3 years?
Yeah, so in last probably about 7, 8 years, we have basically done only brownfield projects. We have not done any greenfield projects, except for Macrotech, which was again buyout. So this is the first greenfield we are doing, and asset turn in the greenfield is much lower than the asset turn of in a brownfield, which is why we are expecting only a 2x asset turn. And since this is meant mainly for the European and US market, it will take a little while to build up the velocity in terms of sales because of challenges which can be faced in registration, which is why we have started the European registrations, which are a tad bit easier as compared to the US ones. We started that 2 years ago, and earlier this particular plant also we were trying to split into various phases and go a little slower. But now everything is being accelerated. The whole plant will be available by next year. So we are quite positive about this market, the European and US market. At the same time, we will not ignore where we are already strong with, in the ROW market. And even when this plant is coming up, our next 2 year growth we are looking to funnel from existing markets.
Thank you, sir. All the best, sir.
Thank you.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity. So, in the existing 3 plants that we have, will it be possible to do some brownfield capex, or we'll just have to do some debottlenecking and increase capacity?
Ankit, frankly, that depends on what opportunities present themselves. The advantage of a brownfield expansion is that it takes barely 6 months to 9 months to get the plant up and running. The time period is much shorter as compared to a greenfield, which takes, in our case, it's going to take much longer, close to over 2 years, because we went so slow on it earlier. But we will not let go of brownfield opportunities if we see that, if the demand is strong and there are opportunities, we will not let it go. We will keep our eyes open and we'll look forward for those opportunities.
Sure, sir. And then once this new regulated plant is ready, so there will be a clear demarcation that regulated markets will be served from this new Tarapur plant, and the unregulated markets will be served from the remaining 3 plants, or it's not like that. Like we can use the existing plant also for the European markets.
We can, but we are not planning to do that. We are looking at 2 different strategies. Separate plan for Europe and USA and separate plans for the ROW market.
Sure, sir. Okay. Thank you.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, sir. Thanks for the opportunity again. Sir, this question you may find it slightly premature, but so logically thinking, since you are serving new plant will serve regulated markets largely, and you are expanding your product basket, and even existing products are doing good volume growth. And considering you have mentioned in the past that our existing capacity or plants have limited room for expansion. So for ROW market, do we need to look out for some facility or new capex, something along that line? Are you thinking currently? Because everything, if it's a greenfield, it will take little longer. So maybe you have to plan in advance. So any thoughts on that?
Right now, we don't have any concrete plan on any of the other plants to be put up. But we keep our ears and eyes open, and if the opportunity presents itself, we will definitely take it. So as I said, meaning except for a short period in 2016, where we were not able to grow volume, even though there was a demand because we did not have a new plant available. I don't remember 16 or it was 17, but 1 year we failed. Other than that, in our 20-year history, we have never failed to meet market expectations and demand. We have always found a workaround, and I hope we'll be able to continue doing the same.
Okay. But preferably you would like to first stabilize and scale the regulated market plants and then think about anything greenfield, right? Is that right? If that is how you guys are thinking?
For the ROW market, we will not plan a greenfield one at all because that takes too long.
Okay.
If there's opportunity available, we will look for a buyout. But again, as I said, it's up in the air right now. Depending on how things work out, we will adapt to the situation.
Okay, but no greenfield for ROW. That part is clear.
No such plan at the current moment, no.
Okay, got it. Thank you. That's it from me.
Thank you. To ask a question, ladies and gentlemen, you may please press star and 1. The next question is from the line of Shivan Sarvaiya from Hamavikshan Investment Advisors LLP. Please go ahead.
Hello, sir. Thank you for the opportunity again. Sir, you mentioned about the issues that we are facing at the EU registration end, that there is some delay out there. So, sir, how do we go about doing these registrations? Do we have an in-house team which handles this, or do we rope in consultants to help us with these registrations?
Both ways. We have an in-house team also, and for things which we can't handle ourselves, we refer to consultants. But roughly about 85% of the work is done in-house. Only about 15% is outsourced.
Okay, and these skills were already there at NGL, or they have been, you kind of recruited the required personnel over the last year or so?
No. This team has been set up roughly about 3 years ago.
Okay.
It takes time to start preparing for documentation. So after the team has been growing now over the period, but we first started this probably around 2021. More than 3 years actually, more like 3.5 years ago we started this. So gradually the team has been growing.
And then the strength of this team would be, sir, around?
I don't know because there's a little bit of mixture between QA, RA and QC. So I don't know how many are devoted to filing part actually.
Okay, sir. Okay.
There are 3 teams which work, QA, RA and QC.
Okay. So could you just give the full forms of the acronyms?
So QA is quality assurance, QC is quality control, and RA is regulatory affairs. So RA is responsible for the final filing, but the data is prepared by the quality control and quality assurance teams.
Okay. Got it. And these guys deal with the third-party consultants if required?
Correct, yeah.
Okay, sir. Okay. Thank you, sir. That's it from me.
Thank you. The next question is from the line of Ayush Mittal from Mittal Analytics. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, just to get better clarity, like I've been on the call, but I'm not very clear. So, I think we have mentioned that our new plant we hope to start by what is the timeline on that?
End of 2025 calendar year.
Calendar year 2025.
Correct.
And this is for both the phases, like we were doing it in 2 phases, or this is like some part will start earlier?
No, one part will start earlier by probably about, we hope to be ready by September. Probably take another couple of months to get the approvals with regard to pollution and the FDA and other things. So probably in Q3 of this financial year, we plan to start the first phase where we will start doing the validation batches at this site. And by the end of next calendar year, we'll start the whole plant. But we wanted to get at least one phase started earlier so that at least the validation batches could progress and our filings can start that much faster. So we are aiming to start filings by 2026 for the US.
Okay. And once this plant is ready by end of Q3 of this year, will we be in a position to do commercial operations, or that also takes time?
No. This is just a small plant to do validation batches. Commercial production will start only after the full plant is set up.
Okay. So, and the other thing that I think you mentioned is that this being a greenfield plant, the asset turn will be lower. At the same time, this will be a dedicated regulated market plant. So, logically, we should be expecting much higher margins from this.
Yes.
To be able to justify the kind of gestation period investment that we are doing. Is that what we are working with?
Yes. So we expect margins to be much higher than what we derive from the ROW market.
Okay. And in the meanwhile, because it's quite a bit of time before all this commercial ramp up and those things will happen. Currently, from the existing plants, what would be a capacity utilization, and do we have expectations of further volume growth? Like you did mention, we are seeing good demand. What kind of scope do we have from the existing setup?
I will not like to put any numbers again because I would not like to give a number guidance. But yes, we are operating at 90% plus capacity on our plants currently. And it's impossible in a chemical plant to work at 100%.
90 is quite high. That's why I asked. Yeah.
Yeah, 90, 95 is the best we can hope to attain. And gradually we have been improving our outsourcing also as we go along. So as seen from the cost, from 3.5 crores it's gone to roughly over 5.5 crores. So it will go further in the current year, but we will not lose. The key thing is that our intention is not to lose any opportunity for not having a production pipeline in the background. That is what we aim for.
Okay. That's very good to know that we are already at 90% plus utilization. So perhaps the value terms we are lower because you mentioned that prices have fallen. That is the only reason.
Yeah.
So we have done well on the volume growth in last 2 years then.
We have, yeah. Not this year, not last 2 years. Year before last, demand had fallen.
Yeah, that was a very...
That 2 years after COVID were good. The third year was not very good. So demand fell. Costs were very high because of high chemical prices. And from last year, everything is fallen. Material prices have also fallen, and finished product prices have also fallen. And it's been an uneven journey. Sometimes something's fallen more, which is why the margin has improved actually, in spite of falling prices.
Okay. Sir, if we have to, if you, for the regulated market thing, if we have to expedite on that, are there any things that we can focus more or do something as a company, or this is the standard time that will happen for us to be able to scale up?
So for the US market, there is nothing which can be done because you have to ready the plant, we have to make the validation batches, we have to do the filing, we have to get somebody, a client to trigger the inspection. So manufacture, then create the database for that, which takes a year, then do the filing. So it's basically a 2 to 3 year process. Nothing can be done to accelerate that. For the European one, it can be accelerated, which is why we have already started to write the filings. And then we'll do a transfer of site so that the registrations are valid at the new site also.
Got it. For the US, you said it has to be triggered. Is that a USFDA audit also?
Yeah.
Okay. Got it, sir. Sir, one suggestion I had, given a stock the way it's around like 2,200 rupees. So is there any thought on the bonus split or something that can be done to improve the liquidity? Because that is something a big constraint on the stock, and that will help the shareholders.
We'll definitely take that into consideration.
Okay, sir. Thank you, and best wishes.
Thank you.
Thank you. The next question is from the line of Shivan Sarvaiya from Amaviction Investment Advisors, LLP. Please go ahead.
Thank you for the opportunity once again. So on the question on bookkeeping, sir, on the EU filing bit, so the expenses that we would incur are being written in the P&L, or are those capitalized? If you could give some understanding there.
No, they are being written in the P&L.
Okay. And sir, cumulatively for these 8 filings, what would be the cost that we would have incurred till date, and what would be the cost that we'll incur going ahead?
I am sorry, but I don't have data for that. I can't answer your question.
Okay, sir. Thank you.
Thank you. Participants who wish to ask questions may please press star and 1 at this time. Ladies and gentlemen, you may press star and 1 to ask a question. As there are no further questions, I would now like to hand the conference over to Mr. Rahul Nachne for closing comments. Over to you, sir.
Thank you, gentlemen, for joining us today. We appreciate your time and interest in our company, NGL Fine Chem Limited. I wish you the best and a great day ahead. We will conclude our earnings call now. Thank you very much for your time.
Thank you. On behalf of NGL Fine Chem Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.